Let's take it to the macros, and Maithili Busnurmat, consulting editor of the Economic Times, is with us. Maithili, good having you after a week. Lots of news flow the last 3 or 4 days. How have you digested all of that? And of course, a couple of key important events coming up in the next couple of weeks.
Well, as a good macroeconomist, I can only once again reaffirm that the market and macroeconomics seem to have very little to do with each other, at least in the short run. And ironically, it seems almost, or perhaps even by coincidence, it's come just a week after the Nobel in economics has been awarded to two economists. One who said that markets are completely rational, and the other one who said, well, in the short run, markets are not in the least rational. I'm inclined to agree with the latter, with Schiller, because if you look at markets today, they seem so divorced from what the macroeconomic fundamentals are today. Here's the economy doing almost successively worse and worse. So either it is that markets have nothing to do with, with the macroeconomic fundamentals are being driven purely by inflows from abroad, or it is perhaps, and that perhaps is the hope which we're all clinging on to, is that perhaps markets are seeing something that you and I are not seeing, and they're forward-looking, so they see this wonderful recovery around the corner. Just where that corner is, when it'll arrive, we don't know, but markets perhaps know, and that's why they perhaps are so much forward-looking.
Let's talk more about the currency and where that's headed with Mr. A.V. Rajwade. He's the Forex and Treasury Risk Management Consultant, now joining in on the show. Thanks very much for being with us, Mr. Rajwade. What's your call on where you're seeing the currency headed? Do you think we can likely stabilize at these levels of 60 to 61 against the greenback?
Well, I think right now, for some time now, the demand side has been artificially suppressed because the RBI is meeting the requirements of the oil marketing companies outside the market. Now, let's not forget that that's a fairly large amount. The estimate is about $8.5 billion a month, which translates into $400 million a day. Now, in other words, the demand in the market has been suppressed to the extent of $400 million. Now, can this continue forever? Somewhere, those swaps are going to stop. In fact, last week, there were some rumors that they may stop in the next couple of weeks, but then there was a statement by the RBI that they have no plans at the moment. But surely, they can't continue forever, because what that would mean is that reserves will go down $100 billion a year. Now, obviously, that can't continue. Now, when they taper off, or when those swaps are stopped, what we are going to have is two different changes in the demand-supply equation in the currency market. Number one is that the $400 million a day average, the oil companies will have to buy in the market, and not only that, for some time, they'll have to buy dollars in the market to honor the second leg of the swap. You know, what the RBI has done is, they have sold spot dollars, but bought them in the forward market. So when that leg matures, that demand is going to come back into the market. So I think we may be significantly premature in believing that the stability around 61, 62 level has come to stay.
Mr. Rajwade, you're absolutely right that as and when the oil companies come back to the market and the second leg of the swap has to be honored, we could see a huge change in the demand-supply situation. But given the fact that FII suddenly seem to be again gung-ho on India and so much money coming in, even if not gung-ho on India, but because there seems to be so much liquidity in the global system, do you think this is RBI has just been very lucky that at a time when they're wondering what do we do now, FIIs are coming to the rescue? So do you think the stability can be maintained short-term, at least until the tapering issue is sorted out once and for all?
Well, I'm not too sure. I mean, I admire the bravery of the FIIs coming into India despite so many negatives in terms of both the macroeconomic numbers and, of course, issues of governance, of decision making, of the red and green tapes combining together in their stranglehold all the economy. So I admire their bravery. I'm not too sure that we are continue to get that kind of monies so that something like $8 billion of demand, and for a time even larger than that, the second leg of the swap can be met through capital inflows. I think we should also not forget one other factor, that there are reports that some of the commercial banks are finding it difficult to raise external commercial borrowings in the global markets. So I think the debt market for Indian paper does not seem to be sort of active very much, and this is natural, quite apart from our macro picture, the deficits and so on and so forth. I think most of the global banks are under capital pressure, so they are not too anxious to add to assets, and very few swaps from that source seem to have taken place with the RBI. There have been some FCNR-B swaps, but hardly any ECB swaps as far as I can make out.
Yeah, but there is this feeling generally that the US will now start its tapering maybe only in December or perhaps even later, because they haven't had data thanks to the problem that they had over the fiscal deficit and the budget numbers, etc., the debt ceiling, etc. So the US may defer its tapering to beyond December, possibly even January, by which time Ben Bernanke steps down, Janet Yellen comes in, and then again in February, early February, we again have the debt ceiling coming up again. In which case, do you anticipate a similar flood of FII investment, which perhaps will give RBI much more breathing space than they actually ever anticipated?
Well, I think that all this logic applies only if we are looking at how to finance the deficit on current account, not how to cure it. I think until we start looking at the second point very closely, we, in the sense, our policy makers, our political masters, start looking at that issue, that is not just a question of how to finance it, it's very much a question of how to curtail it, because what media commentary often forgets is that net negative exports is a drag on GDP growth. Net negative growth reduces GDP from where it would have been in the absence of those negative numbers. So I think it's also linked very much to growth, to job creation, and all the other factors. So I think somewhere one hopes that our policymakers also start looking at how to curtail the deficit. Now, the complacency seems to be that the official pronouncements at least are that the rupee is already undervalued at 61, 62. Mr. Mayaram has made that comment 2 or 3 times at least. What I can't understand is that if it is undervalued, then why are so many people, so many ministries demanding higher import duties? Why do we need to impose local content requirement on the investors coming here, and so on and so forth?
Yes, I agree with you entirely, but the government now seems to suggest that the current account deficit will be within $70 billion. Now, is that a safe number for us to expect to be able to finance, or do you think we need to grow the CAD even lower still?
Well, I personally believe that, or agree with what Dr. Reddy, the former governor, has argued in his recent book, that the objective of macro policy has to be to have a zero deficit on the current account over an economic cycle, say over a 5-year period. That's point number 1. Point number 2 also is that I still remember very much the days when 1.5% of GDP as the deficit of current account the authorities used to be comfortable with. Then it got increased to 2.5.